I just wanted to shoot a video on demergers, in particular with a focus around capital reduction demergers. But just before we get into that, don't forget to like, comment, share, and subscribe to this channel. My name is Omar, Chartered Tax Advisor, and I talk about tax planning, tax saving strategies, and the like. And also, before we get into the capital reduction demerger element, I just wanted to mention that there's three types of demergers. Number one would be the statutory demerger, which is specifically or can only be used for trading entities. Number two would be the capital reduction demerger, which I would say is currently most popular. And number three is the liquidation demerger, which is least popular. Why? Because I say least popular, broadly speaking, but for obvious reasons such as, liquidation. If you can achieve the same goals using a capital reduction demerger, for example, then the liquidation business owners, they're not too comfortable with a liquidation. So that's the three types of demergers, and we get involved in all three types, but the most popular being a capital reduction demerger. Now, these transactions are extremely complex. Just to be clear from the outset, they're extremely complex, number one, and there's also high risks. From our point of view, there's high risk in the sense that, it's not something that, is high risk, so therefore don't touch it. It's more around the intricacy, it's more around the nuances being well looked after, the tax implications well analyzed and considered, and therefore ultimately ensuring that the transaction is undertaken with all angles having been considered. So that can be the commercial angle. And it's not only about tax. It's not all about tax. There's the commercial aspects that need to be considered. From a tax perspective, of course, the aim of using the reconstruction reliefs would be to ensure minimal or no tax leakage, and then the legal aspects, broadly speaking, to ensure that everything has correctly been undertaken from a legal perspective, that the new structure, so you might have a group, a property investment group, new structure is so and so, has it been put into place correctly? When it comes to capital reduction demergers, and all demergers, broadly speaking, many taxes need to be considered. So the main tax that would be considered would be capital gains tax, and this is for the companies and for the shareholders. So using specific reconstruction reliefs, in particular section 136, this is for the accountants and advisors or lawyers that may be watching, section 136 TCJ 1992, Taxation of Chargeable Gains Act 1992, to ensure that as long as the transaction is undertaken in the correct manner, and this is why you must engage a professional to look at such transactions, there'll be no capital gains tax due. I just want to add a massive benefit that I feel is sometimes unspoken of, which is around the fact that when we're looking at properties or property investment companies, or even you have a holding company, trading subsidiary, investment subsidiary, one of the massive advantages of undertaking a demerger is the fact that the properties can have a revised uplift in base cost to market value. So you can wash away significant gains within these for these properties. So if prior to sale, for example, there are other angles, anti-avoidance and the rest of that needs to be considered. But broadly speaking, you can achieve an uplift in base cost of properties. This can be residential or commercial. In the example of, trade, holdco trade investment subsidiary, at times that investment subsidiary owns the commercial property that the trade or the trading entity trades from, or that property might be owned in the holding company. It just depends. Every single circumstance is different. So as I mentioned, capital gains tax on the shareholders, corporate gains for the companies must be eliminated or minimized using reconstruction reliefs. Moreover, we have income tax, so looking at the shareholders' personal tax positions. We have employment-related securities that need to be analyzed and considered. VAT issues, stamp duty. Stamp duty at 0.5% is usually, if I'm using the right term, uncompromisable. So stamp duty in these type of transactions is usually payable, but it's payable at 0.5% on the value of the shares. A valuation must be undertaken. And the outflow or the stamp duty exposure is minimal in comparison to achieving the ultimate goals of the shareholders. Now the shareholders, I'm sort of going back and forth, but this is just a freestyle video. The shareholders can be, usually in these type of circumstances, we're looking at larger entities, number one, and number two is usually you'll have unconnected shareholders. So obviously connected by way of shareholding, but unconnected otherwise. So two family units, for example, or two friends. It can be to be honest, it can be like 2-3 brothers, for example, or a few family members, but all looking to go their own ways. And it's important to then undertake such a transaction in the right manner to ensure that each individual shareholder's goals are achieved tax efficiently. So then we have the VAT, stamp duty, as mentioned. We have obviously corporation tax. We're dealing with companies here. We have stamp duty, land tax can sometimes become relevant as well. Obviously, when we're looking at properties, capital allowances, and the compliance and reporting must be considered. Of course, we can't just undertake a transaction and the compliance, the reporting is all over the place. So we advise on that aspect as well, and we can help complete that aspect, or we can, we work with accountants, for example. We work closely with accountants, and we usually provide a completion pack to the accountants or to the law firms, whoever's in, usually the accountants, they'll be the ones that are dealing with the day-to-day, and that's where we can assist, because there's a lot of angles. For example, how do you show if you're talking about a dividend, a distribution, just a random example, but if you're talking about a dividend, for example, what's the debit and credit entry? Some may think this is basic, but many, they don't know. So these are the kind of angles that we can look at, and luckily for you, I have a strong accounting background as well, but we focus in tax advisory projects. So when we're looking at restructurings, insertions of holding companies, transferring trade and assets, demergers, linked investment companies, whereby you can have you have a group, and then you have linked investment companies on top, where you can extract dividends tax-free, instead of taking out dividends in your personal capacity and then investing in your own, whatever you want to do, whether that's property, stocks and shares, or whatever it may be. And then we have, the other transactions coming to the end of a business life cycle. For example, the sale of a business to a third party, management buyouts, disposal tax-free, CGT-free to an employee ownership trust. And then we look at inheritance tax planning as well, quite closely for business owners, tax inquiries and investigations, for example. So do reach out. As I say, my name is Omar, Chartered Tax Advisor. Email address down below, omar@aswatax.co.uk. I hope you found this video beneficial. Hope you found it useful. As I say, a bit all over the place, in the sense that, there are videos that I sort of prepare for, and then there's other videos that I like to keep it casual. And I'm active on LinkedIn, so feel free to reach out there. YouTube, obviously, you may be most likely watching on YouTube or LinkedIn, and you can also follow us on Instagram. Speak to you soon. Cheers. Bye.